Now today the market's kind of shrugged off a rather nasty open. We were down about 18 points at the open, did rally back. We still finished negative for the day on the S&P, still down about 6 points, but much better off than we started this morning, which we were down 18. So that's the good news. And really, there's a lot of good news for the market overall in terms of where we are currently. We talked about really this continued rise in the markets that we've really seen since really kind of the February lows. And we've had a very nice trajectory here going higher. But the markets right now are sitting on important support. But there's some good news here because, again, we talked about increasing our exposure to equities back over here when we initially broke above a really important kind of overhead resistance. That was that 100-day moving average. And I said then if we could break above that, that would give the market some clearance to move higher. And we added some exposure to portfolios. And since then, we then consolidated. We broke out here again. And we're wanting to add further exposure to the portfolios. But at this point, the markets have gotten a little bit overbought. They've got a little bit ahead of themselves. And we ran into some really important resistance here going back to old highs. And so that this kind of cluster of this direction and overhead resistance really proved a little bit more than what the markets could muster. But the important thing here is that the markets are holding this uptrend line that's currently in the market. So that's bullish. That's really good news. More importantly, the 50-day moving average is about to cross back above the 100-day. So that's also very supportive for the market in the short term. So again, this kind of combination of events suggests that the markets want to at least try to move higher over the course of some time here. But there's certainly a lot of risk longer term that still really kind of fronts this market going forward. So again, in the short term, while the market action has been more bullish and we've been adding some exposure to portfolios in the near term, don't mistake short-term bullish action for longer-term action. Because if we look out longer term, we still have valuation issues to deal with. We still have really extended overvalued markets in terms of a variety of measures, in terms of both relative strength and MACD measures, et cetera. We are at levels that have only been previously witnessed at prior market peaks throughout history. You combine that also with the fact that we've got a Federal Reserve and an ECB, which is now moving towards extracting liquidity from the markets, raising interest rates here with the Fed at the same time. That's what's called contracting the money supply and really removing that punch bowl that's been very supportive of the markets over the last 9 years. That's all now going away. Plus, you've got global economic weakness, and now we're starting to contend with trade wars, etc. That all potentially has some rather negative consequences moving out towards the end of this year, the beginning of 2019. I don't know exactly where the bang moment is, but at some point this is going to matter what happens here. So this is very likely a process in the market that we may get back to old highs this year, we may not, but there is still some risk here. But in the short term, as I was saying, we don't want to mistake the fact that things are trending positively, and we want to give the bulls the benefit of the doubt momentarily. But again, while we're looking at this on a short-term basis, and I've been laying out over the last couple of weeks this idea that we would probably have a retest of this 100-day moving average and another move higher, I still think that's the most likely pathway right now for the markets in the short term. But again, like I said, I'm going through all this tomorrow in our report that's coming out on the website. So make sure you go by our website in the morning. It's a technically speaking update. It'll be out in the morning by the time you get to work. But if you go by the website, realinvestmentadvice.com, and just plug in your email address, I'll email it to you tomorrow as soon as it gets published. So that'll go out for you as well. You'll get it there. And again, we'll go through all this tomorrow in terms of where the markets is, this whole issue over trade, and the impact to earnings. One of the big drivers for stocks over the course of this year, and really kind of going back to earlier this year, if we go back to the beginning of the year in particular, and look at where the market was, we had this big run up in January on the expectation of better earnings because of tax cuts and tax reform. Well, the problem is that trade wars will clip off about 11% of that expected earnings growth. So that pretty much puts a big damper into what the growth for earnings was already going to be. So if that comes out to be the case, and again, one thing I'll be writing about later this week is the collapse in earnings expectations. Just in the last month, earnings expectation for S&P 500 stocks for the end of 2019 has already declined by $6 a share. So again, we're already starting to see the markets adjust for all these things. And of course, lower earnings per share makes valuations higher. and then that all becomes problematic for stocks longer term. So keep a watch on that. The other thing we're continuing to watch here very closely is simply looking at interest rates. And despite the fact that interest rates are supposed to be taking off to the moon, the 10-year Treasury simply just remains kind of locked in this very tight trading range that they've been here for a while. And despite all the concerns about rising inflation, rising interest rates, and all this other thing that's going on, bonds still find a bid when there's ever a worry about the markets. And even this morning, right out of the gate, bonds were getting the bid this morning. They did wind up selling off during the day as markets kind of regained their feet under themselves. But the 10-year Treasury tends to be the go-to safe haven when there's a problem in the market. So don't discount that fact that bonds are still not corresponding with what everybody's telling you about the stock market. There's still a risk-off trade that's going on. Money is moving into bonds. Money participated in utilities today. If we go back and look at some of the sector exposure and where markets were participating in particular, we had money moving into utilities. We had money moving into technology again today and also into energy. But this is despite the fact that energy prices were down early this morning. And you have money moving into utilities, even though things are supposed to be more optimistic for the market. So that continues to show a bit of that rotational kind of safety trade that goes on. So keep a watch on that as well. All right, we'll take a quick break. We're going to come back, pick up with our guests. We'll talk about real estate. We've got some other stuff to get into tonight. Stick around for the Real Investment Hour. I'm Rose Lance Roberts. John Camariano is in the studio with me tonight. And we'll also take your questions, comments, and phone calls. Be sure to get by the website, realinvestmentadvice.com. Get registered for the newsletter and the weekly update that's coming out tomorrow on the website, realinvestmentadvice.com.
Thousands of mothers die when their sons go off to fight and lose their lives. I said, war! Good God, y'all. What is it good for? Absolutely.
Follow Lance on Twitter @Lance Roberts or go to realinvestmentadvice.com.